We know that there was no rate increase as expected. The Fed did drop a line saying it's monitoring inflation developments closely. It also said it's also adding this new word symmetric. Talk to us about what that means, because the fact that it added this new word in a statement that was meant to kind of signal everything is as is seems meaningful.
Well, I think it is the most meaningful word in the statement. It's sort of like the old Groucho Marx show where the magic duck comes down when you say the word, and you get $50. So that's it. You picked it. You got $50. But what it means basically is that if inflation, having hit 2% and their target goes to 2.1 or 2.2, that it doesn't cause them unnecessary concern. It may go back down to 1.9 or 1.8. It sort of gravitates around 2%. But let me point this out for those that think this is something startling and something new, that Ben Bernanke and Janet Yellen acknowledged that 2% was not a cap. That 2% was always going to be a target around which inflation would presumably circulate. So it's new for the last 6-12 months, but it's certainly not groundbreaking and doesn't deserve $50 from the magic duck.
But we did have a debate after the last Fed bill when we were talking about just how sensitive they are and whether they have a greater sensitivity to an overshoot to the top side relative to the downside. Are we saying here actually that, as you just pointed out, 2.2 means the same as 1.8 in this current scenario?
Well, it does suggest, and the statement said that they will monitor on a meeting-to-minute meeting basis, or an economic number that may change one month or another. They will monitor it on a short-term basis. But it basically means that with the rest of the world in a low inflationary environment, actually the EU can't get out of the 1 to 1.5% zone themselves, probably because their currency has been so strong. But a 2.1 or a 2.2 probably doesn't matter. On the other hand, as a caveat, let me just mention that there are forces in the U.S. economy, mainly a weak dollar, with the exception of the past few weeks or the past month, that may force inflation a 0.1 or a 0.2 higher on a 12 to 24 month type of basis. We have a real economy that probably will be stronger in the second half based upon a near $1 trillion deficit and the Trump programs of corporate tax cuts. And so, there are arguments for both sides, but I think perhaps 2% is certainly not a cap for the Fed, and that's what the market is interpreting today.
I'm glad you mentioned the US dollar here as well, Bill, because the last time we spoke to you, you said, look, you can't get above a 2% Fed funds rate in a 2% inflationary world, because then you start to see the dollar pick up. That causes a problem for EM. It might force the hand here of the ECB, the European Central Bank, as well. What do you make of the pickup, the rally that we've seen in the US dollar? And do you think we can see that rally further as we push throughout Q2 and Q3 here?
Well, it has been surprising to most. It's actually only a 3 or 4% increase, but it had been going down for several years, and I think it went up basically because the market anticipated the Fed would be much tighter than the ECB or the BOJ, and certainly what we've seen over the past few months and from Draghi and from Kuroda would suggest that. However, if the Fed moves significantly higher, and I only expect a June rate hike, by the way. I don't expect 2 or 3 or 4 or 5 or 6, going forward. I simply don't think they can do that if Draghi and Kuroda and others basically maintain their excessively easy monetary posture. That'll force the dollar higher. That'll put emerging market countries with dollar-denominated debt in jeopardy and could, disrupt the rather fragile financial balance on a global basis.
So what is an investor to do, Bill? Where do you see value? We spoke earlier with BlackRock's Jeff Rosenberg. He sees value on the front end of the yield curve. What do you do? How do you position yourself through the rest of 2018?
Well, I think there is value in cash, and that's a stretch, of course, because cash for most investors and money market funds and so on is still probably in the 1 to 1.5% category. But 3-month LIBOR is at 2.35, and corporate short-term rates are around 2.5%. Is that a value? It probably just keeps you apace with inflation, but it certainly doesn't go down. The bond market itself in the past 4 or 5 months in 2018 is basically down about 2 to 2.5%, and stocks, who knows on a daily basis, but they're flatlining too. So is it a value? I think it's a safe short-term haven until we see how things shake out.
We've also seen the Treasury announce a significant further ramp up in issuance and where on the yield curve ultimately that's going to set. And we've obviously for the last decade seen very little correlation between supply and yields right now. Do you see Q1 and the explosion of supply that we saw and the sort of rally, the ramp up in yields as an anomaly, a coincidence, or do you think that correlation has changed as we push throughout the year?
No, I think it should be correlated. I don't see it exactly in terms of what investors anticipate from the standpoint of supply. I mean, we know, for instance, that the Fed is undergoing quantitative tightening, perhaps taking or adding 30 or 40 billion to the market for other outside investors to buy. We know that the Treasury itself, is adding to 2s and 5s and 10s and 30s, probably at $1 billion, an auction. Is that significant? Well, it's certainly different. And we know it may even go higher based upon the potential deficits going forward. So in my view, supply from the Treasury is a factor in addition to what the Fed might do in terms of a mild bearish tone for U.S. bonds, U.S. Treasury bonds. I would expect the 10-year, for instance, now at 295, to basically meander around 280 to perhaps 310 or 315 for the balance of the year, but not much of a change. It's a hibernating bear market, which means that the bear is awake but not really growling.